the biggest casualty of the financial crisis. Today we acknowledge a grim anniversary. Lehman Brothers shuttered its doors 10 years ago this very day, and the great financial crisis was underway. A decade on, America is still shoveling its way out. The stock market has gone on a run for all time, it is true. But the Main Street economy appears to have acquired a permanent limp. Not one year has GDP grown at 3%, while recoveries from previous recessions routinely exceeded 3%. Meantime, the national debt pre-crisis was roughly $9.5 trillion. The government of the United States borrowed $11.6 trillion since 2008. Today the national debt rises above $21 trillion. But the American economy expanded only $5.1 trillion these past 10 years. That is, while GDP has increased 35% since 2008, the national debt has increased 122%. The Keynesian multiplier has taken up division. As sovereign man Simon Black notes, every borrowed dollar since 2008 has generated only 44 cents of economic output. We await the breathless explanation of Paul Krugman, arch salesman of the Keynesian business model. We recently revealed the specific economic impact of post-2008 unconventional monetary policy. This includes QEs 1 through 3, NIRP, ZIRP and 3/4 of the English alphabet. The combined results, as summarized by analyst Daniel Lakal, in 8 of the 12 cases analyzed, the impact on the economy was negative. In 3 cases, it was completely neutral. It only worked in the case of the so-called QE1 in the US and fundamentally because the starting base was very low and the US became a major oil and gas producer. For emphasis, in 11 of 12 instances, unconventional monetary policy proved either negative or insignificant. Again we turn to Torsten Slok, chief international economist at Deutsche Bank. The conclusion is that US QE1 had an impact, but in all other cases the impact of QE and negative interest rates has been insignificant. And in 8 out of 12 cases, the economic impact has been negative. Radical changes as those above get no hearing in normal times. But come the crisis, we are forced to guzzle whatever medicine is on tap, however bitter side effects be damned. Was there a man outside the economics departments of Ivied institutions who would mount a soapbox and yell for negative interest rates? Imagine being charged to house your money in a bank. A fellow proposing it would have been packed off to a farm. Not nearly as funny as the word suggests. But Lehman fell. A few short years later whole swathes of the civilized world were toiling under negative interest rates. Many still are. Absent the Great Crisis, it would not have been. Nor would the rest of the financial witchcraft conjured into being these past 10 years. Come the next crisis. Negative interest rates, the banning of cash, helicopter money, etc., we will likely be treated to the entire menu and probably more. The modern world is insane, said G.K. Chesterton once upon a time, not so much because it admits the abnormal, as because it cannot recover the normal. We have lost the normal. Only one question remains: will we ever recover it? The next financial crisis is right on schedule, 2019. After 10 years of unprecedented goosing, some of the real economy is finally overheating, costs are heating up, unemployment is at historic lows, small business optimism is high, and so on, all classic indicators that the top of this cycle is in. Financial assets have been goosed to record highs in the everything bubble. By the dip has worked in stocks, bonds, and real estate. What's not to like? Beneath the surface, the frantic goosing has planted seeds of financial crisis which have sprouted and are about to blossom with devastating effect. There are 2 related systems-level concepts which illuminate the coming crisis: the S-curve and nonlinear effects. The S-curve, illustrated below, is visible in both natural and human systems. The boost phase of rapid growth/adoption is followed by a linear phase of maturity in which growth/adoption slows as the dynamic has reached into the far corners of the audience/market. Everybody already caught the cold, bought Apple stock, etc. The linear stage of maturity is followed by a decline phase that's nonlinear. Linear means 1 unit of input yields 1 unit of output. Nonlinear means 1 unit of input yields 100 unit of output. In the first case, moving 1 unit of snow clears a modest path. In the second case, moving 1 unit of snow unleashes an avalanche. The system isn't stable. It's brittle and fragile. Eventually some nonlinear dynamic manifests. A blight that's resistant to the herbicide destroys the crop, an insect that's resistant explodes out of nowhere and eats the crop, etc. Pushing the system to an extreme only made it more vulnerable to an increasingly broad range of disruptors. Systems made to appear stable by brute force application of extremes will never be stable. Stability arises from all the features erased by brute force application of extremes. The previous two bubbles that popped in 2000-01 and 2008-09 both exhibited nonlinear dynamics that scared the bejabbers out of the central bank/state authorities accustomed to linear systems. In a panic, former Fed Chair Alan Greenspan pushed interest rates to historic lows to inflate another bubble, thus ensuring the next bubble would manifest even greater nonlinear devastation. 10 years after the 2008-09 global financial meltdown, analysts are still trying to understand what happened. For example, the new book Crashed: How a Decade of Financial Crises Changed the World by Adam Tooze is an attempt to autopsy the meltdown and investigate the mindset and assumptions that led to the panicky bailouts and frantic goosing of a third credit/asset bubble, the bubble which is about to pop with even greater nonlinear effects. This is the nature of nonlinear dynamics. Everything is tightly tied to everything else. Tightly bound/connected systems are hypercoherent, i.e. every component is tightly bound/correlated to other components. This is how the relatively modest-sized subprime mortgage market, $500 billion, almost toppled the entire $200 trillion global financial market. The vast imbalances created by 10 years of unceasing goosing will unleash a nonlinear avalanche of reversions to the mean and rapid unwinding of extremes. Consider the impact on hedges, a necessary function of the financial system. With yields so low, the cost of hedging negatively impacts returns, so hedging has been abandoned, trimmed, or distilled down to magical thinking, shorting volatility as the can't-lose hedge for all circumstances. With shorting volatility being the one-size-fits-all hedge, the signaling value of volatility has been distorted. The same can be said of other measures. The information value of traditional financial signals have been lost due to manipulation and/or goosing. The interconnectedness of global markets means a small blaze in a distant market can quickly become a conflagration. Put these two together and you get a perfect setup for crisis and crash. Nobody really knows anything because the signals have been distorted, but everyone thinks they know everything. Sell volatility and buy the dip. It works great until it doesn't. Meanwhile, beneath the best economy ever, the rot is accelerating. For example, empty storefronts are proliferating throughout New York City's neighborhoods. This is an example of the distortions that will be unwound in the next financial crisis. Desperate for yield in the near-zero yield world engineered by central banks, investors have piled into commercial real estate and overpaid for buildings as the bubbles in rents and valuations expanded in tandem. These owners are now trapped. Their lenders demand long-term leases that lock in nosebleed rents, but back in the real world, no business can survive paying nosebleed rents, and agreeing to long-term leases in this environment is akin to committing financial suicide. If you actually want to make a profit, it's impossible to do so paying current commercial rent rates. And if you want to retain the absolutely critical flexibility, you'll need to adjust as conditions change. You can't sign a long-term lease. Everyone signing a long-term lease today will be declaring bankruptcy in 2019 when the recession trims sales but leaves expenses unchanged. In other words, neither small business nor the bottom 90% of households can afford this best economy ever. The financial markets have completely disconnected from reality, and the process of reconnection will unravel all the imbalances and extremes and deflate every interconnected bubble. The current fantasy is that bubbles will never pop and recessions are a thing of the past. Financial engineering can maintain bubbles and growth forever. Everything is distorted to the point that those wandering the hall of mirrors believe they know everything they need to know to continue reaping fat returns on capital. Conventional thinking that performs well in linear eras is disastrously ill-prepared to navigate non-linear eras like the one we'll be entering in 2019 right on schedule.